everyone, I am Arjun Parthasarathy, founder INR Bond speaking. I would like to talk about what's in store for Indian government bonds, corporate bonds, the rupee, and the Sensex and Nifty, given the current volatility in the market, and what can potentially happen going forward, and what would be the movements of these asset classes down the line. Now let's come to the current period of what's happening and why it's happening. We have seen very sharp falls in the equity markets globally and in India. The markets have been tanking. Some days the movement has been 10% down globally and in India. And quite frankly, it's unnerving investors. The rupee has touched all-time lows, while the 10-year government bond yield touched lows, but then shot back up again, while corporate bond yields rose largely on the back of worries over the Yes Bank collapse and the fallout of the additional Tier 1 bonds write-off. Now, why has India faced this kind of volatility in markets is clearly one is obviously the coronavirus that has affected global markets has wrapped itself around what's happening in India in the prior period. Right, the economy was slowing sharply below 5%, multi-year lows, largely on the back of weak consumption demand as well as weak investment demand. And frankly, investment demand hasn't gone up over the last 8 years. That's quite a sharp, long period for investment demand to stay down. We all know the reasons why, because of bank NPAs and lack of credit, as well as lack of any opportunities given a global slowdown in economic growth. The second reason is the credit freeze post the IL&FS collapse 2 years back, and there has been absolutely no incremental appetite for credit towards lenders, especially the NBFCs, and this has filtered down to markets where credit has virtually frozen to many sectors that need credit, as well as to some consumption activities. Then you had the weak rural demand that hurt sales of automobiles and other consumption items, and also you had a longish period of weak real estate markets, um, largely on the back of high leverage of these real estate companies, and the fact that there's been no great demand for real estate given high prices and the fact that income hasn't risen across the economy. The fourth is the global economy was slow, had slowed down substantially, largely on the back of US and China trade war. And even though the Phase 1 deal was signed in November last year, the effects are still linger on, and with this China coronavirus effects, global trade will stay low for a long period of time. Then you had the Yes Bank collapse, with RBI putting a moratorium and adopting a restructuring scheme, and this has unnerved investors in banks as well as markets, and the fact that RBI wrote down the additional Tier 1 bonds completely also hurt many investors in these bonds, and this has actually increased the aversion towards credits, and the credit markets can stay frozen for a longer period of time. And then finally, you had the oil, where oil prices crashed to $30 per barrel, with Russia and Saudi fighting it out for market share, and also the fact that there is a global supply glut amidst weakening demand due to both economic reasons as well as climate change reasons. So all this has hurt the markets substantially, and with coronavirus now virtually shutting down the whole world, with America now banning flights from Europe, no trade at all going through, borders being closed, and many activities being shut down, the economic impact can be pretty serious. So, what are the responses towards the coronavirus issue and the current global volatility in markets? And it's a very predictable response because nobody knows. The governments as well as the central banks don't know anything else. Governments know how to boost budget spends by borrowing, which is increasing government debt and increasing fiscal deficit, while the central banks will print currency more and more, keeping liquidity extremely high in the system and also keeping rates at record lows. So you have global debt to GDP at record highs of over 300% of GDP. Now, and with governments now adding on further debt, this ratio will balloon. While rates will be zero for long periods of time, and with huge liquidity in the system, the money will really slosh around, not knowing what to do, but serving no purpose at all. So, what happens when rates become zero? It clearly hurts savers because they don't know if they keep money in banks, they get nothing. And if you take an aging population in the developed world, then the savers face a huge problem because they are not able to sustain rising cost of healthcare, even though headline inflation, as per central banks, stay well below the targets. And this also hurts further investment activity, demand, consumption demand, etc., as there is no population growth. And all this filters down to countries like India and China and other emerging economies as global growth issues, and this turns into high risk aversion towards any kind of risk assets. So potentially what can happen going forward once hopefully the coronavirus issue is resolved with the vaccine is that there could be stability. There would be stability, definitely, because of the excessive volatility. The markets will have to stabilize at some point of time. Volatility levels have to come down, and the markets can look forward to more direction on the economy, on corporate earnings, etc. going forward. However, what the aftermath will definitely be a huge government debt overhang that can potentially keep the world under severe growth strains for a long period of time, while rates will stay low, and this will discourage savings at all levels. And this has both opportunities as well as pitfalls post the virus issues. The opportunities would largely be at the short term, where on stability there could be bounce backs across markets, there could be lessening of volatility, and there could be normalization of curves, whatever the currency curve, the yield curves, government bond curve, credit curves, etc. The prices of oil is going to stay down, largely because of the fact that anyway oil is in a supply glut, and even though the prices may bounce back slightly, it's not going to scale any kind of levels seen in the last few years, and this will keep global GDP growth down as whole oil economies will see a sharp slowdown in GDP growth. So with the government debt overhang, you could also face some emerging markets could face some inflationary issues, as typically we see that high government debt leads to less optimum allocation of resources, and that could lead to inflation expectations rising. But even if that doesn't happen, there could be absorption of supply issues of heavy supply of government bonds, and governments could also face more and more interest payments that could constrain any kind of extra spending at their end. And in the corporate bond market, you still have a long way to go for the credit markets to stabilize, because you need to have a stable economy plus stable corporate earnings as well as stable corporate balance sheets for the credit markets to have any sense of comfort to lend traction in the markets. And the rupee is potentially looking weaker, largely because of weak growth in India. And if global risk aversion stays high for long periods of time, then there could be capital outflows from the country. And this is despite the fact that oil prices falling it will lower current account deficit and trade deficit. But with capital flows turning negative, then that would negate all the kind of the surpluses that lower oil can generate. On the equity Sensex and Nifty side, you have, like I mentioned, on stability there could be bounce backs from lower levels, but on a longer term basis, there will be issues of corporate earnings growing, largely because if the global economies and the domestic economies face long periods of slow growth, then weakened corporate earnings will lower valuations for most of the companies. And unless there are companies specifically that are growing much faster, largely due to their superior business models or due to innovation or due to technology, the overall broad market will undergo a wide change in terms of performance. To trust this helps in understanding what's happening to the market and what could potentially be moved going forward. Thank you all for listening.